This is the video demonstration on interest capitalization. In this video, I'm going to work the solution to example number 7. In this example, it says on January 1st, the Shula Company contracted with Adams Construction Company to construct a building for $5 million. Shula Company made the following payments to Adams during the year. So you see a whole series of payments here, 4 different payments that were made at different dates throughout the year. It says Adams Company completed the building on December 31st. Shula Company has the following outstanding debt. Now, first of all, it says specific construction debt. So this was taken out for the specific purpose of financing the construction project. And this is a $3 million, 10% 3-year note with interest payable annually. But then we have other debts that we've taken out just for general financing of the company. And those include a $2 million, 8% 5-year note with interest payable annually, and a $2.5 million, 5% 10-year bond with interest payable annually. Now, under the requirements, number 1, we have to calculate the weighted average accumulated expenditures. Number 2, we're going to calculate the avoidable interest. Number 3, we're going to calculate the actual interest. And then finally, number 4, we're going to answer the question, how much interest should be capitalized? Of course, we know that it will be the lesser of either avoidable interest or actual interest. That is a GAAP requirement. So the first thing we'll do is calculate the weighted average expenditures. Now, to do this, I've set up a little spreadsheet here. I'm going to have a column for the date, the amount, different fractions based upon time, and from that I'll calculate an average of each payment, and then I'll total everything up. Of all the different parts of the problem, this part of it is actually pretty straightforward. So I have 4 payments: January 1st, March 1st, May 1st, and December 31st. So I'll have January 1st, March 1st, May 1st, and December 31st. 4 different payments. Each time there's a different payment amount. So on January 1st, looks like they paid $1.2 million. On March the 1st, $1.3 million. May the 1st, $2 million. And finally on December 31st, $500,000. So those are just the different payments that were made. Now, in terms of fractions, I'm trying to set this up to account for time because I want a weighted average of the expenditures. Now, that first expenditure of $1.2 million was made on the first day of the year. So that means that expenditure was made and it's considered as if it's weighted for the entire year because it was made on the first year. So that's going to be 12 out of 12. Now, the next payment, we didn't make it until the 1st of March. So that means that January and February had already passed. So that payment was only made with 10 months left in the year. The next payment was made on May 1st. So that means only May, June, July, August, September, October, November, December, 8 months left in the year. And the final payment was made on the last day, so that's just 0. So those fractions just help us set up the different time frames for each of these payments and when they were made. Now, 12 out of 12 is the same thing as 1, so the average there is just the 1.2 million. Now, for this one, 10 divided by 12 times 1.3 million gives us an average of about $1,083,333.33. For this one, 8 divided by 12 times 2 million gives us an average of about $1,333,333.33. And then finally, this one was made on the last day, so 0 times 500,000, anything times 0 is just 0. So we will just total all these up, and ultimately, even though we made different payments throughout the year, the average of all the payments, a weighted average, would be $3,616,667. And that's a very important number because we're going to use that number again for a later part in this particular problem. So that takes care of the average expenditures. Now, the second thing we're supposed to do is calculate the avoidable interest. And I've set this up with principal, rate, as well as interest. And this calculation is going to help us figure out what interest could have been avoided had we not engaged in this particular project. Now, the first thing I want to do is think about my construction specific debt. Now, that debt was taken out for the sole purpose of financing this project. So I'm going to use that one first. That was the $3 million note at 10% interest. So that's a principal of $3 million. That is a rate of 10%, which as a decimal is 0.1. So that principal times that rate, that means that for the year I had to pay $300,000 interest just on that debt. So that's on the contract specific debt. Now, I also want to add to that a little bit more. How much more? Well, here's where I'm going to use my number that I got on part 1. I know that the total average expenditure was $3,616,667. So we're saying $3 million of that was the construction specific debt. So I want to add on another $616,666. So that way between the two of these, it will add up to the total. Because see, I want that total to match this total. So that's why I'm tacking that on. This number is the difference between the construction specific amount and the total weighted average. Now the problem is, what's my rate? Well, I don't know what my rate is. So to calculate avoidable interest, I'm going to have to go down here to the bottom and do a separate calculation to get an average rate. To do this, I want to look at this other information here about these other debts. Now we had another one that was a note, $2 million at 8% interest a year. So $2 million, 8% is 0.08. So the interest on that one alone is $160,000. And then we had another one. We had a bond that was $2.5 million at 5% interest. So $2.5 million, 5% is 0.05. So on that one, we paid $125,000 in interest. Now the total principal here, if I add these two together, is $4.5 million. The total interest, if I add the interest together, is $285,000. Now I'm ready to calculate the average interest rate. To do so, I will take the total interest here and divide it by the total principal from here. And that gives me 0.06. So 6% will be that average rate. So I will put 0.06 right here, so that way I can use that as the interest rate on that average amount. I will take that principal, I will multiply it by that rate. That gives me $36,999.96. So when I add these two interest amounts together and round, we're looking at $337,000 of avoidable interest. Now once I've calculated the avoidable interest, I'm now ready to calculate the actual interest. That calculation is actually a lot easier. I will simply take the three debts that I have. The first principal was $3 million. The next principal was $2 million. And the next was $2.5 million. And the three rates involved were 10%, 8%, and 5%. So in each case, I will take that principal and multiply it by the corresponding rate. And that will give me the individual interest amounts. And then I can add all these together to get the total. So that means that the total interest would be $585,000.